Imagine you run this massive, multi-billion-dollar business,
Okay.
and this quarter, you actually sold fewer physical products than you did last year.
Like fewer actual physical items going out the warehouse doors.
Exactly. Fewer items shipped. But somehow, you legally report a 16.7% jump in sales.
Right.
And not just that, an almost 500% increase in your earnings per share.
Which is just wild when you think about it.
It really is. So today, we are looking at McCormick's Q1 2026 earnings to figure out how the company behind, like, Frank's Red Hot pulled off an $866 million accounting magic trick.
And what that maneuver actually tells us about the broader global economy right now.
Welcome to another deep dive. I'm so glad you could join us today because our mission is really to shortcut your way to being incredibly well-informed about the, shifting habits of consumers.
Yeah, and high-level corporate strategy.
Right, and we're doing it all through the lens of a single global food company.
So we are working directly from their Q1 2026 earnings release and their presentation, which is dated March 31st, 2026. McCormick Company is this massive flavor giant behind brands you likely have sitting in your pantry right this second.
Oh, definitely.
French's, Oldie Bay, Cholula.
And it's funny because the spices sitting in your pantry are actually a highly accurate mirror for what's going on in the world.
Oh, absolutely.
They're reflecting global inflation, the intricacies of international trade, and the shifting financial realities of everyday households.
It's all right there in the garlic powder.
It really is. Okay, let's unpack this. Because starting with the headline numbers, if you're just reading the press release, McCormick looks like an absolute juggernaut right now.
Oh, yeah. The top line numbers are incredibly flashy.
Mm-hmm.
Net sales increased 16.7% in Q1 of 2026 compared to the same quarter in 2025.
Wow.
Adjusted operating income was $268 million, which is up 18.8%.
That's huge.
And adjusted earnings per share hit 66 cents.
Right, so if you're just glancing at a stock ticker, you'd assume everyone on Earth suddenly doubled their cinnamon consumption.
Right, exactly.
But the discrepancy hiding beneath those top-line figures is wild to me.
Yeah.
Because total sales were up 16.7%, but organic sales growth was only 1.2%.
Mm-hmm.
And total volume actually dipped by 0.7%.
Right, so fewer physical units of spices and sauces went out the door.
Which is the crazy part.
Yeah, that 1.2% organic growth was driven entirely by a 1.9% increase in pricing.
Wow.
They sold less stuff, but they just charged more for it.
It's kind of like adding a massive scoop of protein powder to a smoothie.
Okay, yeah.
The total volume in the blender looks way bigger, right? It fills up the whole glass.
Sure.
But the base ingredients, the actual fruit and the milk, they barely changed at all. You just fluffed it up.
That's a great analogy.
Mm-hmm.
And what's fascinating here is how exactly they achieved that fluff, to use your word.
Yeah.
Because out of that reported 16.7% total sales growth, beyond the tiny 1.2% organic growth, a 3.1% boost came strictly from favorable currency exchange rates.
Oh, wow.
Yeah, they sell globally, obviously.
Uh-huh.
And translating those foreign revenues back into U.S. dollars provided this huge mathematical tailwind.
Based entirely on macro currency markets.
Exactly. Not from selling more mustard.
Which leaves a massive gap, if you think about it.
Yeah, it does.
If organic sales grew a tiny 1.2% and currency exchange added 3.1%, we're only at 4.3%.
Right.
So that protein powder bulking their total sales up by double digits, it has to come from somewhere else.
It does. And the catalyst for these wild numbers was actually a single transaction that closed on January 2, 2026.
Okay.
It was the acquisition of McCormick de Mexico.
And the detail here is so fascinating because they didn't just acquire a brand new company outright.
Right. They already had a stake in it.
Exactly. They already owned 50% of this joint venture.
Yeah.
They bought an additional 25% to take a 75% controlling interest.
Yeah.
And that specific move contributed a staggering 12.4% to their overall sales increase for the quarter.
Which is massive.
It drove their Americas consumer segment up an astonishing 30.4%.
Well, crossing that 50% threshold completely changes the accounting rules for a corporation like this.
Right, but I have to push back here.
Okay, go ahead.
Because reading the earnings per share numbers made my head spin.
Yeah, it's a lot to take in.
The reported EPS was $3.77. That is up over 500% from the 60 cents reported the year before.
Right.
But Buried in the notes, it says this is largely due to an $866.8 million, quote, non-cash gain on the remeasurement of their previously held equity.
Yes.
So wait, they just bought more of a company they already half owned, and suddenly they get to claim a massive paper gain of $3.22 per share.
I know how it sounds.
Isn't that just accounting magic, moving money from one pocket to another to make the spreadsheets look good?
I completely understand why it looks like sleight of hand to the average observer.
It looks like they printed money.
It almost looks like they generated nearly $1 billion out of thin air.
Hmm.
But there is a very strict mechanism to it.
Okay, walk me through it.
So when McCormick only owned 50%, they used what's called the equity method of accounting.
Right.
That means they just recorded their share of the venture's net income on a single line on their income statement.
Kind of like getting a dividend check from a stock you hold in your retirement account.
Exactly.
Yeah.
But the moment they bought that extra 25% and took controlling interest, the rules mandate a transition.
To what?
To fully consolidating McCormick de Mexico's financial results.
Oh, I see.
They have to absorb the entirety of that company's revenues, expenses, assets, and liabilities right onto their own balance sheet.
Wow, okay.
And as part of that specific transition, the 50% they already owned must be revalued at the new current fair market value.
Ah.
So the $866 million isn't cash in the bank.
Right.
It's the legal recognition that the half they already owned is now officially worth significantly more than what was historically recorded on their books.
Got it.
And if we connect this to the bigger picture, this isn't just a spreadsheet trick.
No.
Not at all. This represents a massive strategic expansion of their regional footprint.
Okay, how so?
By taking control in Mexico, they are vertically integrating and seriously securing their supply chains in a major growth market.
That makes sense.
It diversifies their revenue streams and, crucially, it limits their exposure to the supply chain volatility we're seeing in other hemispheres right now.
Right, but I mean, corporate acquisitions and legally mandated paper gains fortify the balance sheet, sure.
Yeah.
But a spreadsheet never cooked a family dinner.
Very true.
If we want to know how that financial maneuvering translates to what everyday people are actually eating, we have to look at the consumer and B2B data.
Absolutely.
And the presentation slides break this down very revealingly.
They do. They separate the business into two distinct worlds.
Right.
First, there's the consumer segment. So the jars and bottles you actually buy in your grocery store.
The stuff in my pantry.
Exactly. And that segment saw sales up 24.5%, driven very heavily by that Mexico acquisition we just talked about.
Oh.
Then there is Flavor Solutions.
That's the B2B side, right?
Right, the business-to-business side.
Right.
They supply flavorings and coatings to massive food manufacturers and big restaurant chains.
Okay.
And that side saw sales up 6.2%.
Now, here's where it gets really interesting.
Yeah.
Because the presentation gave us these incredible behavioral nuggets about you, the listener, the consumer.
It's fascinating data.
The data shows that financial strain right now is broad-based and persistent. Affordability is the main concern for households.
Without a doubt.
But McCormick noted that value extends beyond just price.
Yes, that's a key distinction.
People don't just want the absolute cheapest thing they can find. They want something that makes a home-cooked meal taste good enough that they don't feel deprived of a restaurant experience.
And this creates a very clear divide between the winners and losers in their overall product portfolio.
You say, tell me about the winners.
Well, U.S. hot sauce is having a massive moment.
Oh, really?
Yeah, they reported strong performance for the 6th consecutive quarter.
Wow.
Brands like Frank's Red Hot and Cholula are performing incredibly well. And it makes sense because a few dashes of hot sauce can really elevate inexpensive base ingredients like rice and beans.
Yeah, it turns the struggle meal into something great.
Exactly. It's an affordable luxury.
But it's not all spacey, because they admitted there's real pressure on Mexican flavor recipe mixes in the Americas. And U.S. mustard is facing heavy competitive promotional activity.
Right, the mustard wars.
Basically, competitors are heavily discounting mustard, and consumers are actively switching brands just to save 50 cents.
We actually see that same financial strain reflecting on the flavor solution side, the B2B side.
Oh, really?
Yeah, they highlighted softness in CPG and QSR volumes in the Americas.
CPG being consumer packaged goods and QSR being...
Quick service restaurants. Basically, fast food.
Got it.
So fast food chains and big packaged food companies are ordering fewer flavorings and coatings from McCormick.
Why?
Simply because fewer people are buying their end products.
Wow.
Interestingly, they contrasted this with China, where QSR performance is actually quite strong.
Really?
Yeah, showing a real geographic split in consumer behavior right now.
It's like the consumer right now is a car driving with the emergency brake on.
That's exactly what it feels like.
There's still forward momentum, right? McCormick noted continued strength in scratch cooking and e-commerce,
Yeah,
but the financial strain is the emergency brake stopping them from pulling into the fast food drive-thru as often as they used to.
definitely.
They are highly selective about which name brand items they splurge on to keep that momentum going at home.
And to keep that car moving, despite the emergency brake, McCormick is leaning heavily into digital acceleration.
Okay.
E-commerce growth continues to be a focus, and notably, artificial intelligence is now actively reshaping how these products are sold.
Wait, let's pause there because I want to make sure I really understand the mechanics of this. How exactly does a spice company use AI to sell more mustard?
It's a good question.
Are they like having a chatbot write new recipes for the back of the bottle?
Oh, it's much deeper than that.
Really?
They are using AI for dynamic pricing and maximizing their search visibility on digital shelves.
Digital shelves.
Yeah. Imagine you are ordering groceries on an app, right?
Okay, yeah.
The AI algorithms are constantly analyzing competitor pricing, regional demand, and even local inventory levels in real time.
Wow.
They dynamically adjust the price of that bottle of hot sauce, or they bid for the top sponsored slot in your search results.
Just to get in front of me.
Exactly, to ensure McCormick captures your dollar precisely when you're deciding between brands. It is algorithmic margin optimization at the microsecond level.
So if consumers are pulling the emergency brake, hitting a wall with price hikes, and fast food orders are down,
Right.
McCormick is kind of backed into a corner.
In some ways, yes.
They can't just keep raising prices indefinitely. They have to protect their margins from the inside out.
And that brings us perfectly to their internal defense strategy.
Right.
Because despite this incredibly challenging environment we just laid out, McCormick actually expanded their adjusted gross profit margin by 100 basis points to 38.6%.
Expanding margins by a full percent in this environment is a massive win for their bottom line.
Oh, it's huge.
But how do you pull that off when your physical volume is down 0.7%?
They rely on what they call the Comprehensive Continuous Improvement Program.
The CCI program.
Right, the CCI program. They are streamlining SG&A, which is selling, general, and administrative expenses. And they're utilizing very disciplined pricing strategies to offset the higher commodity costs they have to pay for raw spices and packaging.
Let's break down the mechanics of that streamlining. What does cutting SG&A actually look like on the ground for them?
Well, instead of just cutting staff, they are investing heavily in a global ERP.
An enterprise resource planning system.
Yes, this essentially modernizes their entire global operation.
How does that help margins?
An ERP system consolidates data. So, for example, if there's a sudden cumin shortage or a shipping delay in India,
Right.
the newly acquired Mexico facility instantly knows to adjust their recipe output or to automatically source from a pre-approved alternative supplier.
Wow, instantly.
Yes, it eliminates all these administrative silos and saves millions in wasted production time and supply chain friction.
It's like pruning a tree so the main trunk survives a drought.
That's a great way to look at it.
They are cutting administrative overhead, those weak branches, and using those savings to invest heavily in the core.
Yes, and they aren't just hoarding the savings either.
Yeah, right. The earnings report shows they poured the money saved right back into a low to mid-teen percentage increase in brand marketing.
Exactly.
They are keeping the roots strong.
Yeah.
But I have to ask, if organic volume is actually down 0.7% across the entire company, and they are relying almost entirely on a 1.9% price increase to show organic growth, doesn't that raise a massive red flag?
It's definitely a concern.
They are literally charging more for less. What happens when the listener hits their breaking point and refuses to pay a premium for name brand cinnamon, switching to private labels instead?
This raises an important question, and it's the exact existential threat food executives monitor constantly.
I would imagine.
McCormick explicitly listed increased private label use in the risk factors section of their forward-looking statement.
Oh, they did?
Yes, they know there is a ceiling to pricing.
So what's their plan?
Their counterargument is that their diversified portfolio, their deep brand loyalty, and those inflation mitigation strategies we discussed are designed to weather this exact ceiling.
Okay.
They believe they have built enough brand equity that consumers won't compromise on the specific flavor profile of their chili mix or their hot sauce just to save a few pennies on generic alternatives.
Okay, so they have a strong internal defense mechanism with the CCI program. They have a massive new, fully consolidated asset in Mexico driving revenue, and they are betting heavily on brand loyalty.
Right.
So what does the map for the rest of 2026 actually look like for them?
Well, they reaffirm their guidance for the year, which signals high confidence.
Okay.
They expect overall net sales to grow between 13% and 17%.
That's solid.
But keeping an eye on the details, they expect organic sales growth to hover at a very modest 1% to 3%.
Right, so they're still relying heavily on the Mexican acquisition and pricing to do the heavy lifting there.
Exactly. As for profitability, they expect adjusted operating income to grow between 15% and 19% in constant currency. Yeah. They project a highly profitable year driven by strict cost management and the integration of those new Mexican assets.
So what does this all mean? Bringing this all the way back to you, the listener.
Yeah.
The next time you make dinner and shake some Old Bay onto some shrimp or squeeze some French's mustard onto a sandwich, realize you aren't just seasoning your food.
Not at all.
You are actively participating in a multi-billion-dollar, globally interconnected ecosystem. That single bottle represents supply chain maneuvers in Mexico, currency fluctuations, aggressive inflation mitigation strategies, and complex corporate accounting consolidations.
You really are holding the global economy right in the palm of your hand.
And we touched on how AI is actively reshaping visibility and pricing for these products.
Yes.
McCormick is already deploying algorithms behind the scenes to dynamically adjust the digital shelf placement and the price of something as fundamental to human existence as garlic powder.
Which is just wild to think about. An algorithm deciding if you pay an extra 20 cents for oregano today based purely on regional demand metrics.
So consider this final thought.
Okay.
If AI is already dictating how we shop for flavor today, what happens tomorrow?
Yeah, what's next?
What happens when those predictive algorithms start dictating not just how much we pay, but which flavors are developed, popularized, and trend globally next year?
Right.
Could our very taste buds, the food culture of the entire world, soon be subtly guided and shaped by an AI's profit-maximizing cloud?
That is a fascinating question.
Are we going to be eating what we genuinely crave, or what the algorithm has calculated is the most mathematically efficient flavor profile to produce and sell?
Just an algorithm deciding that next year we all really love smoked paprika because the supply chain margins are optimal.
Exactly. You will never look at your spice rack the same way again.
Definitely not.
Thank you so much for joining us for this deep dive. We hope it added a little extra flavor to your understanding of the world. Take care, and we'll catch you next time.